And to do that, we welcome Dan Suzuki, Deputy Chief Investment Officer at Richard Bernstein Advisors. Dan, is what you're seeing an overreaction to yields at levels that we just have not seen in a year, or is it an understandable reaction, particularly for technology stocks whose income streams go out many, many years?
No, I think the reaction makes total sense. I think that, the reality of high multiple stocks is that you're embedding a lot of growth. That means your profits are far in the future. So higher interest rates, those profits are worth less today. So it makes total natural sense. I think that what you want to do is forget the day-to-day, though, is assume that, rates are probably higher 6 months from now. 12 months from now as well. And so you should be positioning for that in your portfolio, which means, the volatility you're seeing here in those tech stocks is probably not the last of it.
So if I'm going to position for the environment that you describe here, I would assume that would mean moving away from high multiple, high growth, high technology stocks and toward maybe some of the traditional winners in this kind of environment, like financials, like value, maybe smaller stocks.
Absolutely. Tyler, if you look at all the major market indices, they're all heavily weighted toward the same themes. It's US, it's large cap, and it's tech, right? So I think that if you want to be proactive about your portfolios, you should be owning the stuff that's not in people's portfolios. And that stuff happens to be cheaper, but it also happens to be the most geared toward this recovery that we're looking at that's going to take place over the next couple of years. So you can actually get superior profits growth at cheaper prices, and I think that's a rare combination in markets.
What do you make of all this stuff that's been going on with Reddit and GameStop and AMC and so forth? Is that a fool's game to play, or obviously it's so tempting when you see the kinds of returns that are being run up here, but you just intuitively you go, this is not going to work.
Yeah, Tyler, you're absolutely right. I think that half of the story is actually based in fundamentals and is very rational, and the other half is kind of bonkers, to be honest. So the first half is the fact that we're in this big profits recovery, which I think is probably going to be the biggest profits recovery in a decade. In that type of environment, it's usually the riskiest, most troubled companies that do best. And so even before anyone was talking about these Reddit stocks, these troubled companies have been outperforming the broader market by hundreds of percentage points. Now, what's happened over the last couple of months is the liquidity and the Reddit story has taken that to a whole new level, and I think that's a worrisome sign. Retail participation in itself is not negative, but it's certainly not a bullish sign, especially when you're seeing the types of investing is based on stories and charts rather than underlying fundamentals.
Shepard Smith here. Thanks for watching CNBC on YouTube.